China's economic growth slowed to 7.5% in the second quarter, marking a continued slowdown from late last year, but bang in line with market expectations. Joining me now is Shuang Ding, senior China economist at Citi. Shuang, we've had the latest number out. Does that alleviate any concerns people had that the Chinese economy was in crisis mode?
Well, first, I think the data is in line with expectations, so the market should have already expected that. Our judgment is that at the current rate of economic expansion, the government will not roll out stimulus to boost the economic growth, mainly for two reasons. First, the credit to GDP ratio is already very high, and the government has an intention to bring down the leverage ratio of the economy. Second, at least for the time being, the government has put a lot of emphasis on reform to make growth more sustainable and to prevent a financial crisis.
If you look at the other data points like trade and manufacturing, they point to a slightly weaker economy. Does this number tally with the other numbers we've seen in recent weeks?
Yeah, based on the data that made available, I think export and import both grew slower than expected, but the net export, I think it made a very little contribution to GDP growth, but still maybe not the negative contribution. And if we look at consumption and investment, consumption improved, investment continued to decline. So this put in a more broader perspective is what the China's economy is undergoing.
Looking into the future, you mentioned the newer drivers of growth, consumption and retail sales, things like that we'll be paying more attention to. Do you think that can make up for the slowdown in other sections of the economy, in housing, in infrastructure, in heavy industry?
I think the consumption will play a stabilizing role, but it may not fully offset the slowing growth of investment and the less contribution from net export. So we expect the growth to continue to slow down, mainly because the June monetary data and also the comments made by the central bank over the weekend indicate the monetary policy has shifted to a more neutral position, and the credit condition in the second half may become less accommodative. And on top of that, we talk about the reform initiatives which could bring short-term pain before they can reap long-term gain.
I mean, you mentioned credit conditions. We had the very high-profile liquidity squeeze in June. Do you see that having a lasting impact on the Chinese economy?
I think that is an indication that the government is worried about the high debt level of the economy, especially for the non-financial corporation. The total social financing, for example, a new concept introduced by the central bank, has reached about 200% of GDP. So that is another worrisome sign, And going forward, the government will at least first to slow down the expansion of credit.
You mentioned earlier, reform as being the main focus for the new administration. What kind of reforms are we talking about?
The reforms will mainly focus on financial and fiscal side, and also a number of reforms related to the urbanization. In the financial sector, it's mainly about exchange rate, interest rate reform, and also the capital account liberalization. But what is more important in my view is the capital market development to make the whole economy less reliant on the banking system. That is another way to reduce the debt level of the economy, but rather to develop more the other capital market like equity financing and the bond financing. Fiscal reform could include taxation reform, including the VAT reform that will be broadened to nationwide from August the 1st. And the property tax could be introduced. The pilot program can be introduced in more cities this year.
Shuang Ding, thank you very much. And you'll find plenty more on the Chinese economy at fd.com/China.